My trading student that has no prior experience made on the demo account first $1,100 last week. He made $1,412, lost $312. He had 3 winning trades. He had more losing trades, 4 losing trades as you see here. And he saw in total 12 opportunities to trade. And out of 12 opportunities he took, he was only trading 7. The next week you can see here that David, when going here to school, you can see here on the right side, this is the community, this is where we work on the trading school. You can see how he had 1 losing trade and 1 winning trade. The 1 losing trade was a bit big, 162, but the winning trade was $812, and then it was $650 for this week. And the interesting part is very important. He had 10 trading opportunities, but he was thinking a lot. He was taking time to make good decisions, to take the trade that made the most sense out of, and out of 10 trades, there's 1 or 2 single trades. And I think this is something what is very important when it comes to reading. So in this video, we will talk about the last 5 years of experience, what I did with trading students that within 3 or 7 months, I get so far people that they have results using a demo account. And I have few people within the first or the second year, they start working with a real $3,000, $5,000, even $50,000 or even greater account using using this method. Okay, first of all, this is an Excel sheet, of course, and in this Excel sheet for me, it's just important to see if the person is valuing his time. It's always about, this is very important. The first one is, can I see when I'm sitting down 1 or 2 hours on the computer, $2,000 or $3,000 moves within like 1 or 2 hours trading? Because after 2 hours trading, it goes, the longer we sit on the computer, the harder it is to trade. You need to imagine, I think the first most important thing is always when sitting down on the computer, you want to see $200, $300, $400, $500, $800 moves that you have enough leverage to trade at. So the money making is not the biggest struggle here. The biggest struggle is more like if you want to take the $800 move, that you might also lose $800 because it goes in both directions, not just in one-sided direction. And there will be days that the market is more one-sided. That means, for example, we have here a structure and the structure is really good, applied to your trading. That is that if we sit down on a computer for the first time, are we assuming these $2,000, $3,000 moves within the next 2 or 3 hours or 1 hour even, or multiple $800 moves? Are they more one-sided, that it's going more up or down? Or is it more that 2-sided, 3-sided, right? Like 5-sided, it's wiggling around. This is something that's very important. The more one-sided we expect the market is going at, the more easier it is. Here you see, for example, he assumes the market is a bit more one-sided, actually 2-sided because it goes a bit down and then it goes here up, right? He assumes not even that the market will go here to marker, is going to marker number 1 correctly within his trading time, maybe more like having here struggles maybe and goes here into this consolidation phase. That means we'll have problems. Now, picture number 2 shows us what the market did, and you can see how the market was going down. It was going up. He was right with his prediction. But then the market started to push down. And these are one of the hardest trades. That is, when the trader mostly sees on this first picture, he assumes the market is going up. It will be very hard mostly for most trades to trade even down and to take a good trade to trade down. Because the thought was always, I can see an uptrend and I'm assuming the market is going to market number 1. And this was the reason why he took here not a single trade. If you just look at the other pictures, it's always the same thing. As you see here, this is also one-sided again. He assumes the market is going up. Then the market was really going up. First was a bit smashing here down, you see here, for 2 times, 1 time, 2 times. And then here the third time it was going up. And then you can see here on picture number 3, there's a very high chance that he's also taking a trade here. He was not taking a trade. He was just analyzing, and he was able, because it is his first year trading. He's just a couple of months here. I think it's like 4 or 5 months now. And it's just like about like seeing opportunities, because this with leverage is a $2,000 move. And then when having enough leverage, this is why I love to trade futures. If you are not sure if you want to go with futures or another asset, check out the recent video that I just did, because I just talked about futures trading there, what I experienced the last 8 years with futures trading, why with the money management it is so important to me. So you can see here, he's adjusting here $100 set here. This is a $500 move. This is a learning trade, it is called. That means it is something that he did not saw. One of my favorite patterns, if the market does a higher low, that means red, green, and red, green goes higher. Or if green, red, and green, red goes lower for selling, for example. So red, green, red, green. In this case, he assumed the market is going up. So we search for buying signals. He can see here 1 buying signal, $100 adjustment, $500. Second one, $100, $500 adjustment. And the third one you see here with $100 adjustment, $500 adjustment, did not work that much. The reason why this one worked and why this one worked and why this one not worked is because this is the biggest structure high. And once the market reaches the biggest structure high, the trade quality will decrease by 5x. You need to imagine that. And the main reason because of that is because of when the market is here at number one. I call this always number one. When the market is down here and has here all these color switches, I just was drawing in for you like 4 opportunities. We have actually 5 opportunities, but you have 4 working opportunities with red and green that when adjusting here $100, we get $500 or $900 trading up to this reference. When the market is aiming for this high and we can see it, trade quality is very high because we know exactly it has enough power to go in that direction because we see it, because we are looking the market for 1, 2, 3 months and we get already a feeling with it. Like when we just look at the first picture, we can already tell like, oh, it makes so much sense that the market is structuring up because you see here so many green candles and the structure's up. Just as an example, it comes with experience. So the market has enough push, that's the pro. The other one is also the market is not wiggling around too much very often. That means if you have a market wiggling around and you see it's going to a reference, it is more a consolidation or a contraction phase that shifts up. That's pretty cool. Once the market reached that goal already, here, trade quality decreases by 5 times because first of all, it will wiggle around very much. You can see here red candles are smashing in. Second one, very often the market has not enough power to go to the next reference that is up here. Because when you look to the left, there's literally here nothing. This is something that's very important. What I really love to do is I love to draw in these wicks here as you see here. Because from here to there, there's this big distance. And then you see here from here, here, and there, if you would just go on a 1 second chart, for example, you have here different references. And you can see how the market goes here, and then it's here, retracement, right here, and then goes back. If you don't understand what a retracement is, if the market goes in one direction, it will always retrace. That means that it comes back, and then it first goes in the continuation of the direction. The market is more rotating always. It's not just running in one direction. That's why going in retracement, the trades, I think is very good. That means once the market is coming back and then does a higher low, I really love trading that, just a single small green candle, stop placement there. If the market reached already our first goal where we expected the market is going at, very often the market will wiggle around. It's very hard to trade here. The stop placement cannot be put on any green or any red candle too much anymore. That means the smaller the stop placement, the higher the risk reward. That means we can adjust $100 to get $500 out. But in this case, we would really need to have a very huge stop placement. And this really is just not nice. The stop placement must be here or there. And it's just too big because the risk reward ratio is just killed. Okay. You can see here, and this is something that's very important with picture 1 and 2. It is always about when David sees the market is going up, that he always wants to see also that the market really was going up. There are also certain moves that the market was going down, but as you see here, the main focus, if you see a move going down from here to there, this move maybe just took like 20 minutes or something. You see here from 10 a.m. to, oh no, this one took even 1 hour, you see here, 1 hour move here, from 10 to 11 a.m. If you look here at 11 a.m. to 1 p.m., you see this was a 3-hour move. And the thing is now with leverage, if this is a $2,000 or $3,000 movement, this is a $7,000 move. Like, you just need to imagine, like, if you have the time to sit down 4 hours on the computer, as David, for example, from 9 a.m. to here 3 p.m., the thing is like, where do you see the highest amount of chance the market is going at with your experience? Because when you concentrate on the bigger move, you will have way more opportunities. I'm going to make you an example here. Here you have green and red, for example. That did not work when trading just this because you have a lot of green candles. But it's just about first one showing this one to you on a dead chart because I assume the viewer here is not used to trading color switches. It's about to searching green and red candles. And especially the ones that worked. Because you can see here only one time here, a color switch, green and red, somewhere in between, what makes it very unrealistic that we hit this one between all these 7 other color switches, or 8, 9, 10. And then here you see first time a green and red that has a risk reward ratio of 5. But this green and red here, for example, when adjusting here $100, that's just like $200. So that's something that's very important. You see here the market does the push down. This here, adjusted here $100 is here $500, $700. And now check this out. David more assumed the market is going up. And now here it comes. You find here the first one, red and green, that this one would have worked with the risk reward ratio of 5. Red and green, this one would have worked with the risk reward ratio of 5. Red and green, what David drawed in, risk reward ratio of 5. So we already see afterwards 3 opportunities that it worked. And on the realistic side, because the market did here first a lot of green candles, the market does red, green, and then a higher red, green. Of course, this one has a way better quality. So this is something what is better to trade. And this was why he said this was his learning. But David was first able to take the better trade up here and check out what happened. You see here, red, green here, red, green here. You see red, green here, like a lot of red and green candles. Then when placing the stop placement here where I put the white line, that it would have worked with $500 each. This is why I love to use the 1 minute chart, because we have 60 candles within 1 hour. That means we see like, oh, here, red, green, $500 worked, $500 worked, $500 worked, and it goes higher and it works, right? So making here on A2 then the trade while being able to see this makes totally sense to trade this than real. And then you see here also up here, right? Because this is the biggest structure high, by the way. Keep in mind, this is like a medium structure high. This is where it gets dangerous a bit. This is where the market has complications. But very often, if you have these highs here that I'm drawing in, that are very near, the market will smash it out just at one go. And then the market will go on complications. This is something what is very important in terms of reading and market experience by looking at it over and over again, having always the same market. So you can see here, you have your 5, 10x, more the color switches that works in reference to the movement that just happened down. Let's just continue. When you see the market is pushing out, right? Very often the market will spike back as you see here. And this is something what totally sucks. And this is the main reason why we have 3 trading qualities inside. You have trade quality 1, before the market reaches this goal. Trade quality 2, the con is not enough power too much, wiggling around too much. The pro here is smaller stop placement, more movement inside, like literally like trade, like the one trades is like when trading, I think starting with $300, $500 a trade. If it's $5,000 for the next 5 weeks, that's not a $5,000 account. It's just like how to work with money if the market works good. The thing is like, I want to place mostly number 1 trades. I don't want to place too much of trade quality number 2 or trade quality number 3. Because on trade quality number 2 is like the market is having decreased push, right? It got down by 50% or even 70% already. The retracements are bigger, they're double as big. But number 3, they're like, man, they're so big. The retracement is, just look here how the market tries to spike down. Even though it rotates higher, it spikes down so aggressive. That means very often I cannot just enter after a green candle and place the stop at a green candle. Very often if I have a red and a green candle, I need to place my stop placement down here, enter here. And then instead of having a risk reward ratio 1 to 5 here, like it just got decreased to a risk reward ratio of 3. I'm going to show you an example. If I have here a red and a green candle here, and I'm entering the trade after a green candle, I have the stop placement here. This one is a risk reward ratio. This would be $800, $900 then. The problem is that if I enter here now the trade and I place the stop placement here and adjust with my position size here $100, that's only $400, $350 or something. So it decreases our trade quality extremely. And it is very important to understand like most wars or like how much trades am I using? How much money am I using for the next 5 weeks or for this market situation that I'm seeing right now with my experience? All depends on picture number 1. Where do I see the market is hitting at? What makes sense? And he was drawing in here number 1 at 5643, makes a lot of sense. And then you can see here 5643, the market literally was also reaching the target, right? But very important is also if he says like he sees at 5643, like up here at a high here, that the market goes up here. Let's just show you this one. Oops, clicking here. If he assumes the market is going up to this 564, hold on. He said 5643. I gotta check this out because of this high here. 5643 is here from the deep left side here. That means here from the high at 9 a.m. 9 a.m. That means if he assumes the market is going up here, there you see, you have also between stations such as this high here, because this is like a medium high. And then when you see the market is pushing here up, you know exactly you need to check here that the market has problems here, because if you just look at the smaller perspective, you see how the market is here in this price area just doing these retracements. Like it's like if you see a consolidation phase that looks like this and then it goes out like that, and you have here this high, sometimes you have here also a high here in between very often. This would be very good. It is very important just to assume that the market goes to this area, that it goes up here and we'll have complications inside. When being in a trade, somewhere here in between, before the market reaches this one, let's just assume it looks like this. We buy here, we have our stop placement here or something, risk reward ratio of 5 would have been fulfilled. Like now we can let the trade wiggle around or something and do this stuff. That's no problem, because now we can exit here with $100, $200, $300, that's no problem. And we know exactly on this high here, the market is going to spike back a lot. The thing is just, this is the main thing. On trade quality 1, we can let always the trade run. Trade number 2, it's not that, it's getting always harder and harder to manage the trade more and more in that direction. If we concentrate on trade number 1, by the way, we can also do swing trades overnight. But here's the thing, in the money making activity, it's always about, here I have $1,000 for the next 10 trades, for example, on a not real money account, please. Then when using $100, I want to make $500 for each trade on average. That when losing 7 times $100, for example, that's minus 700. But when making 3 times $500, that's 1,500. And then minus that, you literally made $800. That means the $1,000 almost got duplicated. That's something what is very important on the mathematical side, that we can have only 3 winning trades and 7 losing trades and still make thousands of dollars if we repeat it over and over again. By the way, this is no financial advice, very important. Hope you could take something out of this video. Wish you all love, good trades. JT out.